Hey, what's good, everybody? Happy Friday. What a week, man. This was one of those weeks that just we covered a lot. We did a lot of geeky sort of talk in the beginning of the week. We're going to wrap up sort of following up on that and sort of rounding everything off this week. If you're a first-time viewer of ours, I'm a financial advisor with Jazz Wealth. We help you with your investments, your retirement accounts, exchange-traded funds, 401k rollovers. We help you with that. We have a very unique offering here at Jazz Wealth. And one of the things we do is these videos. We just try to educate you, teach you things that maybe aren't always all that exciting. But if we can teach you something that helps you with your dough, helps you get your dough straight, then mission accomplished. So this week, what we've been doing so far is sort of talking about speed. We've been talking about this, how portfolios move. And so many people are used to just dealing with mutual funds, where you buy a mutual fund because you just know you're supposed to, right? You just buy it and hope for the best, or you hope you bought the right one. And so there's not really a lot to learn there. It's like, buying a lottery ticket. You just buy it, see what happens. Now, I'm not comparing them to lottery tickets, but you get the idea. You don't really know. So we talked a lot about speed this week and how our portfolios at Jazz Wealth, how they move and how you can sort of measure that speed to tell whether you should be beating the market or should you be trading at about half the speed of the market. So we worked through that. Well, it's about halfway through the year, and it's normally the time where people should check in on their investments, check in on your dough, take a minute and do it. You got to do it now because you got Amazon Prime Day coming up, and they're going to be all after your money. They want you to spend money on their site. You've got the 7-Eleven, of course. July 11th, you go to 7-Eleven, you get the slushies, you end up buying all the candy that's there, right? So we want to make sure that you can get your dough straight, check in on it, make sure you have enough money to go to 7-Eleven or to go on Amazon Prime or to just go on a vacation, right? And so one of the things I want you to do is take a look at your investments. Take a look at your retirement. There's a few really, really important reasons. We're going to cover those today for you, but why not take 10 minutes and go, am I investing right? Should I be more aggressive? Should I be more conservative? Should I stop? Should I contribute more? Where am I at? What's going on? Take 10 minutes, learn. If you're one of our customers and you just don't know, ask me. Let's talk about it. Happy to help. Okay, here's the thing. Last year in the stock market, most of you did really well. I hope you did really well because last year the S&P returned 22%, I believe. The market as a whole returned 22%. Now, if you are younger and you didn't get all or more than that, then you really need to check your investments. If last year you returned something of a fraction of that, it could be that you are close to retirement and you're taking less risk. That's okay. But if you're younger, you should have got all of that. Here's the thing. What happens the year after a record move, right? That was a huge move for the stock market. That broke records. What happens when the stock market has a record move in one year? What happens the next year? And why would we even ask that question? So that's kind of like the geeky stuff we talk about around here, and then we go do the stats, because I want you to invest based on stats, right? So let's try this here. Last year, I'm sorry about the audio, by the way. The mic, I was hoping would be here by now. It is not. Should be here in a little bit. It's all my fault, by the way. I tripped over the thing. I ripped it was a whole mess. If we could have got that on video, you guys would laugh for days. But so the normal mic that I wear, I broke it. So my fault. Anyways, last year, 22% the market's return, okay? Now, what we want to know is what happens the next year, right? Could you figure that out? We can. And if you figure that out, then you know what to expect on average, right? And it's like when the markets fall. Remember in February, the stock market fell 10% like that, man, just a couple days. It was actually 12 days. And so we brought up the question, what happens when the market does that? How quickly does it recover, right? What's the statistics behind it? We put it all together, did this class for our customers, and now our customers know, oh, I don't have to be scared. So when the market does that, it's not a big deal. Actually, we even took it a step further and made this towel. If you're one of our customers, I keep telling you about this towel. Tons of them have already gone out, but if you're one of our customers, I want you to have this, okay? So let me know that you want one and let me know that the address is correct for you on file. I want to send you that towel because now you know from the classes that we've done that you don't need to be scared, right? So when you get a little nervous, when the news channel makes you a little nervous, I want you to wipe your sweat off with that towel, relax, read the quote, you'll be fine, okay? Now here's the thing, 22% is what the stock market did. Do you think that over this entire year, the market will do that again? Yes or no? Anybody that's watching, leave me a comment in the thing. Do you think it will do that again? 22%. I personally don't think it will do that again, but I won't use my opinion. I'll use a stat. I'll look it up. We're going to do that class for our customers. Check out the events tab. We're going to post that probably this weekend. What happens the year after a big move like that? Now, here's what I want to give you right now. You got 22% last year from the bottom of the market. So let's say this was 2008. The markets went. Since the bottom, what has happened to the stock market? If you were around in 2008, what fun that was, wasn't it? The bottom actually came in 2009. Since 2009, the markets have averaged an annualized 15%. So you're looking at a 15% return year over year, and on average in the stock market, okay? Huge recovery. That is almost 10 years, okay? So let's see. Do you think the next 10 years will average 15%? Do you think that there will be another 200% move higher? Some people do, right? Actually, where was it? JP Morgan did a study, and JP Morgan said their study, was it JP Morgan? Yeah, their study asked 1,400 people, some of their customers, what do you think is going to happen from this point? 68% of people said, yep, that's going to happen again. That's going to continue. 68% of the people thought that. If I was JP Morgan, I'd be super worried if I was them because those customers are going to be very disappointed. 20% of the people, so we're up to 88% now, right? 20% of the people said they think the markets will do better than what they've done over the last 10 years. This is JP Morgan's customers. You think like the most wealthy people on the planet work with them, and they do. And that's what they think. That's what they've set them up to believe. So ask yourself, do you think that's going to happen? We've got rate hikes. We've got stock prices at the most ridiculous valuations we've seen in a while or ever. We've got trade wars going on. I'm not saying the markets crash, but don't you think we're running into a little bit of a headwind there with all the stuff going on? Now, you could have said that 2 years ago, to be fair, right? I don't think the markets crash from here, but do I think they return 15% average? I don't think so, right? So that's the first thing I want to give you today. When you check in on your portfolio, you're going to spend this weekend, right? You got nothing to do this weekend. You're going to go look at your retirement portfolio, right? You just log in, right? You got it. So the first thing you're going to do is lower your expectations, right? Wouldn't you rather expect less and return more than expect 15% on average and get 2%? Right? You're going to be disappointed. So with everything that's going on, every analyst, go watch financial TV for 20 minutes and you'll see every one of them say, I think the markets will be doing well, but they will not do what they have done in the past, okay? So aside from the people that think the market's going to crash, and those people are never right? So they get one of those right in their whole life and all of a sudden they're a hero. Like the guy with the housing market thing. Have you ever seen that guy? There's a great show. I think they made a movie out of it. The guy that called the top of the housing market called like the top of everything, everywhere, every year, and he just happened to get one right, and all of a sudden he's famous. Rich, by the way, but famous. Okay, so here's the thing. Lower your expectations. Look at your retirement portfolio. It's done well. You've killed it, right? If you've been in and disciplined and investing consistently, you've killed it. No problem. This year, have you noticed? It's like, what's going on? Why aren't I making any money? I've got a little bit there, but it's not that exciting. That was exciting, the 15%. JP Morgan is actually telling their same customers, they did that study, right? Customers responded, 86% of them said, yeah, man, keep it up, keep killing it, you guys are doing great. So then they did a report, and they issued it to all their customers that says, listen, we are expecting 5.5% average returns for the next 10 years. So that was the best they could do, right? Whereas we'll tell our customers the stats. We'll go through and figure out exactly what has happened, and then, of course, going forward, right? JP Morgan had to get people to sort of calm down because if all of their customers were expecting 15% a year or greater, they were about to lose a bunch of customers, right? The whole Jazz Wealth be knocking on the door taking some customers. But So they said 5.5% average the next years. Vanguard said even less. So if you have accounts at Vanguard said 3.5 to 5.5. They didn't want to give a specific number. They wanted to give a range over the next 10 years. That's the returns they expect. So if really the brightest of minds, I'm not ragging on JP Morgan or Vanguard or anything, that's what they do. They analyze the markets. And if the best they have, the best people they can hire that you pay for at those companies, by the way, says 3.5 to 5.5%, you got to go with it, right? You got to expect that in your head. So the first thing, I want you to lower your expectations, okay? Which means it becomes very important to check your allocation, right? How are you invested? So everywhere else on the planet says 60-40 stocks to bonds, 70-30 stocks to bonds. What the hell does that mean, right? If you're a brand new investor, you're like, okay, stocks. What stocks are they? If I'm invested in stocks, are they all like local, like here in the United States? Are they global, right? And bonds, what kind of bonds are we talking about, right? I hear this all about bonds, interest rates going up. How do you know? What are you invested in? So the rest of the world says that. I say speed. How fast are you moving? If the markets go up 10%, what do you want? Do you want 8%? Right? If the markets go down 10%, are you okay to lose 10%? If the markets are up 10, let's say they go up 15% again, and that's the average, right? It keeps going up 15%. Do you want 18 or 7 or 4? Maybe you're really close to retirement and we need to only take a little bit of what the markets do. Why? Because if they fall 10% or they fall 15%, how much do you want to take a hit, right? So that's how I say it. I want to do speed. I want you guys to know that when you look at the TV and they say the Dow was up 100 and some points today, the S&P gained 40. You go, well, that's great. I should have gained some percentage of that, right? Maybe not daily, but over the course of your life, you want to be able to say, well, if the markets close the quarter, right? Today's the last day of the quarter, up whatever, you want to be able to say, okay, I'm playing along at 50% of that, or I'm playing along at 110% of that, right? So I expect to see about that. That's how I want you to think of it, okay? We talked a lot about speed this week, and that has to do with the overall volatility, the overall aggressiveness, the overall speed of your portfolio. Which, by the way, if I could just throw this in there real quick. The one video we did about how you trade with no commissions, this tenths, hundredths, thousands. That's 2/1000ths of a cent. Just to clarify that. I think I said 2 cents maybe 4 times, and then I said 2/1000ths of a cent. And some people think I don't actually know that that's 2/1000ths of a cent. Just throwing it out there. You like to be clear, you know what I mean? So anyways, we talked about speed. We talked about how this goes, okay? Here's what the important part about checking your allocation is. You ready? This goes back into the geeky talk. It's Friday. Let's do it. So, if you had 60-40 stocks to bonds, and again, I'm sorry about the audio if that messes you up. Let's say 5 years ago, you said, I can't do it. You said 60-40 stocks to bonds. That's my allocation. That's what I'm happy with. And you did nothing over the last 5 years. You just left it, right? Remember what the markets did. We were averaging 15%. So your stocks, 15%. Your bonds didn't do so well, so not much you can do about that. If you didn't touch anything for 5 years, you know where you're at right now? Without touching anything, you are at 80-20. You go, Dustin, well, what happened? I was allocated 60-40. I was cool with that. Now you're allocated 80-20. So if you did 60% stocks, 40% bonds, magically you're at 80-20 because of the speed of the markets relative to your holdings. Go check out the videos we did earlier in the week to explain exactly what that nonsense means. But you have to take a look at your portfolio. You've got to rebalance back to what it is you want. Now, it's been 5 more years, so you may even want to take less risk, okay? If the markets fell 50% right now, remember, you're now allocated 80-20. You're taking a 50% hit on your stocks, all right? You don't want that. Remember, you wanted to invest like this. Hopefully, I'm making this clear, right? So the speed of your portfolio becomes increasingly important as the markets increase. The markets haven't done anything all year so far. In my opinion, I don't think that counts as anything. Up and down, wild moves, no big deal. You probably don't need to do anything at this point. But if you've been holding on for 2, 3, 4, 5 years and you thought you were at some allocation, I can promise you, you are not. You need to make that adjustment. Get some help. If it's something we can help you with, let us know. Okay? The last thing. So that was the second thing, right? You notice I got an eraser too. So the last thing I want you to focus on is your costs in the accounts you cannot control. That's supposed to be a K. 403B, 457, right? All the other ones. You do not control these accounts. You think you do. You get to choose from a list of investments, and unfortunately, I only know this because I see it every day. People just kind of randomly choose. You either randomly choose the investments in your 401k, or you do what Dave Ramsey says because it's Dave Ramsey and Dave Ramsey said so, so I must need to do that. Kid you not, right before I just came on here, got an email from someone that said they want the Dave Ramsey mutual funds. Please tell me which ones to buy. No. Ask Dave Ramsey, right? He says to buy a certain mix of mutual funds, okay? So all the time, this is what I see. Nobody asks questions about costs. Nobody asks questions about speed. Nobody asks questions about how they will perform in the future. So picking a random set of mutual funds or whatever Mr. Ramsey says, I'm not saying what he's telling you to do is bad, but understand what it costs. There are some of those mutual funds that know Mr. Ramsey focuses on that, and they charge obscene amounts of money. And then there are others that just do their thing. They're good, decent growth mutual funds, decent bond funds, all this stuff. They're great funds. So if you're given a list of, 18 different mutual funds, right? You want to go through and say, okay, my goal for my account is aggressive growth. All right, now you've got these to choose from, right? The next thing you want to do, don't look at the performance. Who cares about the performance? Because if they're growth funds, they're already put in the right format. They're there ready to go. Those fund managers are not stupid. They are very good people. So, not good people. They're good at what they do, right? So you've got now 4 to choose from. You want aggressive growth. Now it comes down to speed and cost. That's where you should be looking, okay? Because over the long run, if you just hold that fund and you're getting that growth, but they're charging you 2.5% plus 5.5% up front, that's something that happens, right? That doesn't make sense, right? 1%, 0.5%, right? If you want aggressive growth, those people are working hard to make sure you get that. So don't go and look for the one where you're going to pay them way too much. You want to go in there and be like, okay, I'll buy the one fund for 0.5% or 1% or whatever it is. The point of this is to focus on those costs that are out of your control, because you can, right? You can put a good mix of mutual funds together that don't cost very much and still move in that aggressive way that you want, okay? So don't look at it backwards. I just kill you, right? It just kills me to watch that happen. So that's it. That's all I wanted to focus you on today. I want you, number one, lower your expectations. JP Morgan says so, right? 5.5% is what everybody's expecting. Vanguard's a little on the lower end. They think 3.5 to 5.5%. Number two, I want you to just take 10 minutes, look at your portfolio and go, yep, that's good. Or look at it and go, I don't know what that means. I bought that like 5 years ago. I'm not sure what's going on there. Figure it out, right? You got to know where you're at, because you are now more aggressive than ever, even though you didn't do anything. Please do that. Number three, I want you to focus on the cost of those products. I don't mind you have to pay something for the 401k fees, the 457. You're paying fees in there, net fees, not the one that everybody tells you to look at. What is the final cost, right? Think of the final cost. So I want you to look at that. You can pay more if you want, but just make sure it's giving you exactly what you want, okay? So if you're getting better performance or something, you want to pay more, no problem. Don't pay any upfront costs. I can't tell you. Almost everyone that I looked at this week, 401ks, had the Fidelity Advisor funds. Anytime you see that, that means we're charging you up front because we're advising you. No, they're not. They're charging you up front, okay? So that's it. Okay, I'm going to wrap it up there. Got a lot to do today. Just wrap up the week. If I can help you in any way, let me know. Go to jazzwealth.com, click chat with Jazz. We will be back with our new mics. Everything will be fixed next week. If I helped you in some way today, please hit the subscribe button with the little bell. That'll let you know when we go live. We will be going live again at 4 o'clock today to wrap up the markets, talk about this day. That was easy, right? Didn't I just tell you yesterday that's what would happen with the banks and everything? That was sort of an easy day. Let's hope it stays that way. We will talk about that later and update you on that. If you're one of our customers, stay tuned to the events tab. We're going to add that next class for you, and also taking requests. Some of the classes coming up are because of popular demand by our customers. So if there's something I can touch on that is more detailed, you really, really want that sort of detailed stuff we just don't put here on YouTube because we'll get in trouble, let me know. Other than that, I wish you guys a great weekend. If we don't see you later, enjoy. See you later.